Hey everybody, good morning. It's Pete. Welcome to Stocks for Breakfast. Today is Thursday, March 26, 2020. Today we're going to talk about some stock picks. We're going to talk about some scans. We are going to get into the news today. Jobless claims coming out today. But first, I want to give two very quick, actually three very quick intros in the beginning here. First is Glenn. Very good job of structuring yourself. And also good job of leaving a comment below the video. If you have questions about anything I talk about, sometimes, I get 20 years of experience doing this, so I could rattle off some stuff pretty quickly. Do like Glenn did. If you have any questions, drop a comment below the video, and I'll get back to you as soon as I can. If you find the videos helpful, absolutely subscribe. I'd really appreciate that. First thing I want to talk about is this book. If you are a trader or even just somebody who absolutely loves the market, you absolutely owe it to yourself to pick up this book. This book was written in 1923. It's called Reminiscences of a Stock Operator. It's pretty much considered the trader's, I'm not going to say trader's Bible. It's probably one of the most fascinating stories in the world. It was written by a guy named Edwin Lefevre, Lefevre, if you want to pick it up on Amazon. It's basically the ghost-written story of Jesse Livermore, who many consider was the greatest trader of the early 1900s. He had such influence over the market that he was actually responsible for a couple of market crashes where JP Morgan actually had to go and ask him to stop selling stock to prevent the market from going down. Unfortunately, the end of his life was tragic, but that's what makes the story so powerful when you know that and you're actually reading it. So I would, with all of us quarantined right now, which by the way, I hope everybody is doing okay and is healthy. Pick it up on Amazon. You'll drop me a comment. Tell me what you think about it. It's actually a powerful read, despite the fact that it was written in 1923. Next thing I want to talk about is a tip, for lack of a better way of putting it, but it's more of a trading tip as far as how to manage positions. Once you get to a point in your trading where you understand what to do, you're losing less. The next stage is obviously to learn how to make more money, right? But every once in a while, we have like these brain farts where you get to the point where you're like, I held one trade too long, and that one trade blew out my last five. So here's a key, and you want to write this down. This is what you call a writer downer, and essentially comes down to this: if you're ever in a position and it's not working out, or you feel like, you know what, it's a loss that could become a bigger loss. That's actually a better way to put it. Ask yourself this question: if I didn't have it, would I want it? Because it immediately takes you out of the emotional attachment to the trade where you're like, well, I have it, I have to prove myself right, or no, it's going to come back, or the ultimate BS is I know the stock. Get that out of your head. Ask yourself, if I didn't have it, would I want it? And you get the answer immediately. And 9 times out of 10, if you're asking yourself that, of course you don't want it. That's why you're asking yourself, right? But listen to the answer. The answer comes back like that, and you immediately kick the trade out because you didn't have it. And here's a big thing that people don't know too about trading. You don't have to exit the entire thing. Lower your exposure. If you bought 1,000 shares and the trade's not performing quickly, maybe it moved against you and something changed in the market, but you still like the idea, lower your risk. Cut it from 1,000 shares down to 300. You don't have to hold the whole thing. Lower it. You can put them back on. Everybody's trading for free now anyway. Most places have free commissions, right? So the next thing is, on the opposite side, is for profit taking. If you have a good trade, and actually John and I discussed this in his coaching call yesterday, if you have a winning trade, which by the way, John, awesome job holding the trade, doing exactly what we just discussed, what we're about to discuss. If you're in a good trade and you don't see a reason to exit, don't exit because you're up a certain amount of money, because you have to eventually learn to make the bigger winners to offset those smaller losses and wins that kind of wash each other out. You need some of the bigger ones. So if you're in a positive trade and it's moving in your favor, and sometimes you can pause, which I'll show you actually a situation yesterday in the SPY where it kind of went sideways for like 45 minutes, but there was no reason to get out of the trade, and you hold it. So ask yourself, is there a reason to get out other than my P&L? If the answer comes back no on that one, hold it until you see a reason on the higher time frame. So hopefully those things will give you help. So let's go right to the charts. I know that's what everybody wants to get into. So as I said, first thing this morning, jobless claims coming out today, definitely something to keep an eye on. Everybody is expecting it to be monster numbers for obvious reasons. You know, I mean, what's going on in the world right now, a lot of people, unfortunately, losing their jobs, and businesses, mom and pop businesses, especially, closing. So keep an eye on that and see how the market reacts at around 8:30 today. You can see we were all the way up here in the futures, actually in the market yesterday, which actually this is something, you know, I'll talk about it in the SPY when I get to the SPY in a minute. We were all the way up here and we kind of just slowly drifted back. I was actually hoping that we would close here, open higher, and then actually look for some profit taking to come in for a spot to sell short. But that game plan kind of got ruined when we kind of floated all the way back down here in the afternoon. And that was definitely profit taking in the afternoon. Don't read too much into that. The market exploded for basically 2.5 days, so to speak. If you remember the video that we did on Monday, if you scroll back a little bit in the YouTube channel, you'll be able to see where it says the case against selling short. And we've actually rallied since then. So now I'm kind of on the opposite side of that because short-term profit taking came in. So that's where we are now compared to where we were. Look at the jobless claims in the afternoon. Something I want to talk about over here, again, this is something that I'm super happy that a lot of people are either emailing me or writing in, first starting to understand order flow a little bit, and understanding the significance of learning how to read the tape. And here's the opening price. If you remember yesterday, we actually said do not buy the higher opening, and thankfully we didn't, right? But here's the interesting thing. We were looking over here to see if the sellers were quite ready to say, okay, enough is enough. We actually got perfectly back to the opening price. We actually formed a swing high here, but never triggered the short sale. So that was actually a signal that the buyers weren't done yet in this little time period that we're watching right now. So remember, the more of these pieces you can put together in your argument, and I hope you're using my terminology now. I hope you're saying, I want to build an argument for a great trade. A+ trades have great arguments because of what I just did. That's one piece of the argument. Crappy trades, the trades you shouldn't be in the first place, are the ones where like, well, I see the entry. That's bull. That's not a good argument. That's just you're bored. Don't trade when you're bored. So the next part is that we get here. Obviously, what's exciting here is, again, validating the significance of the opening price. We actually held it as first resistance, did not roll over, did not get a short sale signal. Then this actually here was the entry signal. We actually got one close above the open here. You could have entered early there, but then you got a second close. So that was the entry, and a close below this opening price would have been the exit. No reason to hold bigger losses here because it is what it is. It's the opening price. You kick it out, right? So here's what I'm talking about as far as being in a trade and having no reason to exit other than you're bored. Clearly, this is not really pulling against you. It dipped below the open, but it did not close below the open on the time frame that we're watching, which usually for you, just keep in mind, should be the entry time frame. And then we actually had a really nice move to the upside. So this is an area here where one trade yesterday could have made your entire week if you managed it properly, right? Because you would not have been looking for short sales based on the shorts did not have enough power. The bulls did not actually give it up yet, right? And we got back above the opening price and held. So you had a nice little 8-point move here or so in the SPY, and I'm sure that was accompanied by a few stocks we'll take a look at in a second. But here's the significant thing right here. This actually was another entry, right? You have it's kind of like a golden rule of trading. Anytime you make a new high, you make a new low. Trading that first pullback off the highs, absolute must trade, right? But you took it, and you probably end up taking a flat on it because you're looking for this trade to pull back and make new highs. Does not, right? So you basically watched it. You're looking for a new leg up. Does not make a new leg up. So that's a signal. Remember, as I said over here, this was a signal. The fact that it didn't roll over. This is a signal here that did not make new highs. So what does that tell you? The rallies grew feebler and feebler. Remember, we've mentioned that in a couple of videos, which actually is a quote directly from this book. And it makes sense. Price action doesn't change. So you take this trade, you get long. It's the right trade. The right trade probably pulls back, and you end up getting out at the same spot you got in. So you made a good trade that didn't make money, didn't follow through. It's not a bad trade because it didn't make money. It was a good trade that didn't follow through. Bad trades are the ones you make that you're bored, that you don't have an edge, and you build a weak argument, right? So next we actually have another pullback. Now you got to make a decision. Do I trade the same trade again, That's not that the last one didn't follow through. Yeah, probably. It depends on whether or not you want to, grind it out when the market's already up for a couple of days. But this is a clue, and these are the decisions you have to make, right? Taking this trade, absolutely nothing wrong with it. You just have to have your radar on and say the last time it didn't follow through. So that means your trade management has to be on high alert at the previous high, which in this case was here, because this time we did not follow through. This time that has to be your idea for profit potential, at the very least, saying if you can't get through that level, there's no reason to hold the trade longer. Now, we had no idea this was going to happen, but what we did know is that was the previous high, and if we can't breach that previous high, there's no reason to hold the trade, because now that would be twice you failed. So you're starting to see how you put the pieces together to the argument. I really hope that sinks in, because that's a big deal, right? So what we're going to do now is I'm going to go to the daily charts, and I want to look at a stock that we were taking a look at yesterday, actually the last couple of days, Netflix. 380 is a pretty big levels, 380, 384, and you can see here if we zoom out on the charts, right? All of these chances to get through this level over the last, this is going back into 2018. So monster level here, whether it's 380, 385, pick a number, it's up in that area, right? But here's the play that I want to talk about today. Now, obviously, there's no bullish order flow. So these arguments get much stronger when there's good bullish order flow or good bearish order flow, which we're going to talk about in a second on the opposite side. But because Netflix was actually strong, well bid, well bid, well bid, well bid, while the market was weak over these last, let's call it 7 trading days, now we can consider that relatively strong. And again, a super tight window. I'm not talking about a big macro picture. I'm not talking about, we're talking about reading the tape over the last few days, right? So because it was strong over that window, keep that in context, and the last 2 days closed on the low and went what low offered, I'm looking to buy this stock today on a lower opening. And that last part that I just told you is super important. So I want to come back here. A big part of getting the best entries, the entries that you don't sweat out, the ones that you're like, I got them and I'm not, and oh my gosh, that's crazy, right? When you get a stock that's strong or a stock that's weak and rallies, in this case, where a stock is weak and rallies, you're technically looking for what I call in my scans, which I'm going to show you in a second, a weak stock with a strong close. And then you're looking for it to have happened a few days in a row. And the best case scenario is where it closes on the high 2 or 3 days in a row. And then today, for example, what I'm going to show you in Netflix and some weaker stocks, we're looking for, in case of Netflix, we're looking for it to open flat, push lower, and then look to bid somewhere around 50 to 75% of the average true range. Look for a short-term signal, looking for a reversal while it's still going down, but confirming it with that reversal candlestick, either a bullish U-turn or a swing low, depending on what you're looking for on whatever time frame you watch, and then looking for it to retest the high. So in this case here, it's around 372 would be the profit target. So we're looking for it to push lower and then have almost a $30, depending on where the entry is, looking for almost a $30 move back up to just retest where we just came from. So it's got good reason in the current market, exhausting the profit taking over the last couple of days, looking for it to reach a what I call saturation point. That's a term that I came up with, and that's based on a whole bunch of experience. Too much to get into right now in the YouTube video. But that would be the scenario. So I'm going to go back to the screen, and we're going to take a look at some trades on the opposite side of that, which in this case would be weak stocks, which is below the 20, the 50, and the 200, which quite obviously there's 138 stocks that meet that criteria right now. You know that my criteria now is over $1.50 average true range, over 2 million stocks only. But this is the key here. They were up 2% yesterday. So now we start to scan and look for stocks that were strong for multiple days in a row, looking for a potential sell short. So I'm just going to use one example here so I don't make the video crazy long. So I'm going to go into this stock here, ATH, just as an example here to bring the point home. Okay, I'd like to see it a little bit better, but this is actually a good example here. So you can obviously see much better bearish order flow than just the last 7 days, like I showed bullish momentum in the Netflix trade. But in this case here, we actually had a well bid. Now, we did not close on the high, so this is not the greatest example, but it did close 2% higher than the open, which that's a big deal too. That scan is from the open, not from the previous close. That open means, generally speaking, although this closed off the high, big red or big green candle. So we're looking for a massive couple of days buying or selling in a row, in this case buying, closing near the highs. Eventually that saturates or exhausts itself. We're looking for that one final push high where everybody's caught on the wrong side because profit taking comes in after a certain amount of time, and then you can ride it back down in the direction of the longer trade. Now this one here is actually an interesting one, and I didn't plan this, but today's trade in this one, we'd be looking for a flat opening to push higher, test the previous day's high, fail, and then roll over. Let's see if we can find a better one. Actually, we might be able to find one here. Let's go to the list of stocks that were strong yesterday. So that did not close strong. I'm looking for something that closed. I want a little better one than that one. Nope, a lot of these stocks closed off the high yesterday, so we don't have the best case scenario. But hopefully you get the idea. So anyway, you can scroll through the list of stocks, see if anything meets the criteria. So what would you be doing from there? Let's actually take a look at Square. Square might meet the criteria. No, that closed off the highs again. But what I'm going to do with Square, just to give you an example of what I meant. So the average true range in Square is 737. So let's just say 7 for argument's sake, just to keep it simple here, right? So if we go back into Square, what we'd be looking for in Square is, because of the bullish reversal, well bid. Now we had 2 gaps here, so that actually is something that would make me stay away from this trade. Again, reading deeper into the argument, I would not want gaps. I would want flat openings and push, flat openings and push. But let's take that out of the equation for the illustration of this lesson. Closed yesterday at 52.39, and let's use $7 as an example, even though it's 7.37. I just want to keep the math simple. So that would be $7 plus 52.39. That would be 59.39 would be the average of where the stock would go today. So assuming it closed and closed at here, but we just, again, illustrative purposes only, we're looking for it to rally a certain percentage off of the average true range, and the average true range is what it normally does from low to high over 14 days in this case. And that an area in there is where we'd be looking for a short-term reversal for this weak stock that's bounced a couple of days to turn around. So what's interesting is we're actually talking about stocks that have been, in this case, strong the last couple of days, closing strong, and then looking for a spot to actually see it reverse and go back down. So it's I'm not even going to call it an advanced strategy, but it's really more a context of the fluidity of the market, where you have nice order flow going in one direction, you have profit taking, come back, and the system price action tape reading that I'm showing you right now is really just the fluidity of the market, where you can use it for entries and exits. And there's more to it. Trust me. I'm giving you the overview of the context of how to read the tape and what to look for. So when you combine that with trading the opening range, understanding where you are from the previous days, high or low, you well bid, well offered, and that kind of stuff, you start to put together the pieces really, really quite nicely. The one thing I do want to take a look at is I want to see which stocks were actually negative yesterday relative to the market, and see if there's any interesting setups coming in. Actually, we got a nice little consolidation here in Twitter, which over here, if you remember, I don't know if I was even doing the videos at that point, we were actually looking for Twitter to break out. It was showing some good relative strength after this gap, but obviously the world changed at that point. ROKU, we were actually, if you caught the video a couple of days ago, we actually said to keep an eye on ROKU for an inside candlestick breakout. We actually had an inside, close to an inside, and these are the kind of trades here too. So this is actually interesting because ROKU actually saw a little bit of profit taking similar to Netflix. So I think I might be looking at that one as well today too, but actually on the long side, but only if it's trading above the open. So remember, that is the criteria that you want to have. It's one thing to have a setup, and this is what separates somebody who's just a chart reader from somebody who's a tape reader that can call themselves a trader. You go into the day with your game plan, but if your game plan's not following through, you don't blindly trade the trade. It's got to meet your criteria. That's not great English. It must meet the criteria, right? You go into the day and saying, I only want to be long. I want to be long this stock for argument's sake. Well, let's just say ROKU as an example. But I'm only going to be long if it's trading above yesterday's close, yesterday's high in this case, and above today's open. So you just don't go into the day saying, I want to be long Roku today, again, for example, and just blindly get long. It has to meet the criteria. So if you go back to yesterday's video, which is how to find stocks after the market opens, you add that piece to the fact that you did your game plan on the higher time frames. You create your game plan going into the day, and then you only trade what's on your game plan. So hopefully we gave some good insights today. Combine yesterday's video with today's video. Get in there and do some scans for stocks that you normally trade. These were just examples, right? I'm not giving anybody advice. I'm just giving you lessons on how to structure these trades. And then leave some comments. If you have any questions about what we looked at, if they're helping you, absolutely leave a comment. It'd be exciting to hear. If you have any deeper questions about stuff we covered, leave a comment for that too. And if you like the video, the Stocks for Breakfast videos, absolutely, I'd really appreciate it if you could subscribe to the video. Have an awesome day. I am Pete Renzulli. Go get them today. Let's make some money, everybody.